Good morning. This is Ken Long from Tortoise Capital Management with a review of the weekly report for March 19th, 2011. The market's in bullish volatile conditions. On an annual basis, it's come back to just above the midpoint on a weekly RSI. On a 10-day basis, it's at the 39-yard line, so on the low end of neutral. The 200-day moving average stretch percentage is down to 8.68%, which puts it into the white zone. It's still bullish, but not as exceptional as it has been in the last 6 months. A state change since last week. The slope of the 50-day moving average has turned reddish color, which has a bearish qualities to it. Yeah, the slope of the 50 is almost flat at 0.07, but that is so relatively weak that it gives us bearish indications. ADX has increased to 25.7. The bad news is that's all from bearish price action, so that's not good. The ATR percentage is up to 1.73%, so at the high end of volatile compared to the last 180 days. And once again, we see the effect of rising volatility on returns. It's inversely correlated. All of the equity regions of the world market model are weak, Asia especially lagging significantly. Precious metals and commodities are dominating right now, especially silver. Monthly and quarterly rebalancing are due to be updated on about 1 April. In ETF2, our theoretical exposure is 0%, with all 10 regions of the world market model being negative on a 5-week rate of return. The model portfolio itself goes to 40%, with symbol VOT being sold by rule for going negative on a 5-week rate of return. Moving on. In the market health check, again, you can see we're looking back 10, 20, and 30 days. The slope of the regression line has gone negative. Price has crossed below the 10-day moving average, which is below the 50-day moving average, and so that's negative. The price action on Friday is negative. It gapped high and then failed hard the rest of the day. We're right in the middle of this potential correction in a bullish market. I'm starting to hear that language now, as we've been predicting for some time. I'm hearing that language from pundits. We are at a channeling position here with the market just coming out of oversold conditions from the harsh sell-off on Wednesday. So right now, the next support level comes in at about 125, which is really the boundary of a normal correction. And if it goes below 125, and then we are into what some folks will consider to be return to the bear. Once it gets past that 10% pullback from the swing high, which still remains at 135. Again, you can see all the regions of the world market model are negative, which takes us to 0% invested, 100% cash in the theoretical model. SPY at 49 is better than EFA at 43. It's slightly better than Europe at 48. And you can see Japan and Asia less Japan just getting crushed. The strongest sectors are U.S. mid-caps at 54, and then U.S. large caps at 49. World market model, everything is suffering except for the commodity cluster. Japan, Asia less Japan, Asian countries all suffering considerably. U.S. technology has just been getting crushed here. Mid-caps are strong, but the NASDAQ is by far the worst in the U.S. Only the energy sector is in the green. You can see technology is suffering worldwide. A response to Japan, I believe. Healthcare and staples remain interesting defensive plays among the sector spiders. Europe is almost on par right here with the U.S. In terms of regional strength. In the 100 by 200 crossover, a lot more sectors have now gone to cash based on price performance compared to the two long-term moving averages. The top 30 ETFs from the ETF2 database continued to be dominated by precious metals, the energy sector, commodities. Top 30 ETFs by average daily dollar volume, and then reflecting in green the ones that are the most volatile, therefore excellent intraday candidates. You see VIX remains at number 15 position with over 6% intraday average moves. Silver and the energy sectors also being very, very tradable intraday. Inside ETF2, the model portfolio, you can see we sold technology. These are three U.S. technology ETFs were sold Monday by rule. DBA was hit, the double position DBA was hit on its trailing stop on Tuesday, and we're selling VOT by rule because of the negative on the 5-week rate of return and the fact that the theoretical model is so low, there's no reason to hold on to that. So the theoretical model will be approximately 40% exposed after the open on Monday. And that's a look at the daily, the weekly. We'll take a look at the daily in our next video.